90% of day traders lose money and less than 1% are able to consistently beat the market. And in this video, we're going to prove it. Now, we're basically comparing the argument of Warren Buffett, who has said by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. He has said that a low-cost index fund is the most sensible investment for the great majority of investors. And everything I have seen since convinces me of its truth. And on the other side, we have the TikTok and YouTube day traders. There are countless of them offering their premium Discord servers, their trading course, telling you by either copying their trades or learning their method, which they won't share for free, you can not only make money, but of course you can outperform the market and make a lot of money. So we have people like Warren Buffett, famous investors like John Bogle, who literally invented the index fund and founded Vanguard, billionaires, and all the examples of famous investors who have not day traded, but have instead stuck to long-term, high-conviction investments. People like Bill Miller, because he was one of the few hedge fund managers that was actually able to consistently beat the market. He himself now has the majority of his portfolio in Bitcoin, which he plans to hold for the long term. Not trading, but a high conviction long-term investment. Famous investors like Michael Burry, who was able to predict the 2008 housing crisis and bet heavily on it with his fund. He had an investment thesis, he stuck to it for years, even while it was down, and he profited greatly from it. Not day trading, not flipping like these TikTok and YouTube investors will convince you is the best way to do things. Also on this side are people who generally know what they're talking about in investing and have been doing it for a long time. Because it's not everyone online, of course. There are plenty of people giving good quality information. YouTubers like Graham Stephan, Andre Jick, in the cryptocurrency space Ben Cohen, and of course myself, who is telling you that day trading is not the way to go in investing. And this is probably one of the most important lessons for you to learn in investing. If you are able to learn this lesson, you are going to be able to outperform the vast majority of investors. And not only the average Joe, but the professional hedge fund managers and people who've been doing this for a long time, because this is the lesson that takes the longest for people to learn. And this is the one that people get stuck on and they can't get over. So if you're able to learn it, you're going to be so far ahead. When I talk to people about investing, their opinion on day trading is the number one thing that lets me know if they know what they're talking about or if they have no idea what they're doing. Now, to many of you, this seems obvious. Now, I've spent a lot of time researching for this video, and it's going to be a long one because here's the key. While it may seem obvious, and for many of you, you won't need that much proof, I have experience with friends, family, and myself years ago when I didn't know what I was doing. I fell for it. I believed some of these Discord traders that there was a way to either trade options or stocks and consistently make money more so than the market. It's a very convincing lie because they show you their Rolex, they show you their Rolls Royce, and a lot of them show you, in quotation marks, their trades. They make it very convincing to make you think that they found out the way to do it, right? Now, of course, in hindsight, we know obviously they're cherry picking what trades they show. I've been in premium Discord servers where literally they will just delete entire channels because they've made too many bad trades and they have to keep up the illusion that they are consistently profitable. It's very convincing. And what I've realized over the years, teaching friends and family, and of course people on Broke Student Advice, is that the only way for you to be able to not ever fall for these is to learn it. Because at the end of the day, if you don't understand why day trading is not a good idea, it's just me and Warren Buffett and John Bogle's word against these day traders, right? All the YouTube influencers, all the TikTok influencers who are constantly barraging you. I mean, on TikTok, every day I see new trends. If you're broke in 2022, it's your own fault. People are making thousands of dollars copying my trades. It's so convincing. And you know, one of these days, maybe one of them will get you and you'll fall for it. And the best way to be able to resist this is to just understand why it doesn't work. So that's what we're going to do today. We're going to prove why day trading is not profitable. And we're going to go more in depth. We're going to talk about why stock picking statistically does not beat the market, why most hedge funds underperform their market sector, and why buy and hold is the way to go for all smart investors. Now, of course, I don't want you to just take my word for it. So I'm going to be linking every source that I cite in the description of this video. And I've reviewed every source to make sure it's reputable. If it's a study, we're going to talk about who wrote it and what their background is. And key to know is that what we're comparing with is people with no sources whatsoever, right? A TikTok video has no citation. They're just telling you that they're able to make profits trading. And while I was doing my research for this video, I found tons of people anecdotally saying, yes, I day trade and it's profitable. Yes, I make money. Usually it was on a forum like Reddit or Quora. And upon further research, I could always find some link to them and a course that they were selling or a part of. Now let's get into it. First, what we're going to talk about is this article that I've seen a lot online. Even God couldn't beat dollar cost averaging. Now give this a read if you want to, because this is a great read in itself, and it's of course linked down below. But basically it just shows you that by dollar cost averaging into the S&P 500, you will outperform nearly every strategy of buying the dip or timing the market. And in fact, even if you have perfect clairvoyance and can buy the exact dips between two all-time highs in the stock market, dollar cost averaging will actually outperform this strategy for most of the time periods sampled. And this article is sampling time periods of 20 years, right? All the way back from the 1920s. And these multi-decade long time periods where we imagine a situation where an investor had perfect clairvoyance and can time the exact dips in the S&P 500, it didn't beat dollar cost averaging. Here's an article put out by the Schwab Center for Financial Research. Now, Charles Schwab, of course, being a famous financial institution. And this article, again, took a look at different investing strategies with investors who have perfect clairvoyance and can time the exact dips and tops of the markets. Of course, literal perfect timing outperformed dollar cost averaging, but only slightly. You're not missing out on much by dollar cost averaging or lump sum investing. However, you are missing out on a lot if you're not investing at all, whether that's because you're trying to time the market or because you're day trading instead of buying and holding. Now, of course, these articles are talking about the S&P 500, people investing into the index and trying to time it. But with day traders, what they're doing is picking individual stocks or leveraged options of those stocks and trying to trade them to create a daily consistent profit. Now, the studies on this show that it is much worse than trying to time the index. Now, here's an article which used data from eToro, which is a brokerage company which has publicly available information on the activities of its traders. So this was a study that analyzed over 83,000 traders and put together some statistics on their results. And here they are. 79.5% of them lost money, and the median yearly return was negative 36.3%. That means the average day trader loses money. And in fact, it's worse than that. 80% of day traders lose money, and less than 1% are able to consistently beat the market. All right, the author of this article concludes, there is no easy method to consistently profit by day trading, and I would be very careful if someone promises there is one. Now, here's one of the most important studies I found, and I found this study cited in a number of different articles. It was conducted by a number of financial professors from the University of California. These guys are economic analysts, they have their PhDs, they've been studying this their whole life, and of course, they're just using data. They're not presenting their own opinion, all right? And they conducted research on Robinhood users. Now, Robinhood is one of the most popular trading apps in the US. And they found as well that the vast majority of traders lose money. Only about 20% earned profits net of fees, and less than 1% are able to outperform consistently. 4,000 out of 450,000 subjects in the study. Furthermore, and here's the most important part, the more a trader traded, the more likely that they were not to be in that 1%. The more frequently, in other words, day traders, or the longer someone spent, people who don't realize that day trading is not profitable, the higher the likelihood that they were going to lose money or trend towards zero. Now, let's stop right here and think for a moment. So far, we've learned that the vast majority of traders, around 80%, lose money, and among that top 20%, around 1% of them are able to outperform the market. Now, the market returns around 8 to 10% each year, right? We're talking about, not the biggest returns. The probability of winning a blackjack hand is about 42%. And if you win that, you double your money. So for the average investor, let's say you watching this video or me, we would be better off betting all our portfolio on a single blackjack hand. We would have a 42% chance of doubling our money, an 8% chance of tying, and a 49% chance of losing. If we just did that once, we would have way higher expected returns than if we were to try and learn day trading. All right, now those same researchers put together a report in collaboration with financial professors from the University of Taiwan, and they tried to look at the data to see whether people got better at day trading over time or they learned from their mistakes. Their conclusion was that rational models of learning do not explain most or all day trading. Nearly 3/4 of all day trading can be traced to a history of losses, and persistent day trading in the face of these losses is inconsistent with rational learning. They're basically saying there's a phenomenon where people are deluded into believing they can profit using this strategy, and they keep doing it. And this, to me, rings so true because I know one of the most common arguments for these day traders online is that you need to stick with it. You need to have a strategy and you need to learn their method. And if you're not profiting, it's because you didn't learn it enough. It's because you need to keep trying and keep doing it and, stick with their course, and they can teach you how to do it because they're profitable. It's not true. And let's continue to talk about why. And here's another quote from that report. For prospective day traders, trading to learn, so trying to learn how to day trade, is no more rational or profitable than playing roulette to learn. Just like our blackjack example, you are literally better off as the average person. And, of course, we all think we're smarter than the average, but let's just talk about the average person here. The average person is better off playing a hand of blackjack or roulette than trying to learn how to day trade. All right. The next source we're going to look at is the SPIVA scorecard. Now, if you're like me, while I was researching for this video, you're thinking, what the heck's a SPIVA? Well, SPIVA stands for S&P Indices versus Active. They are semi-annual reports put out by the firm that runs the S&P. It's called S&P Dow Jones Indices. And using their data, they compare the performance of actively managed funds against their benchmarks over different time horizons. Now, I'm sure most of you have heard of the S&P and Dow Jones. Now, this firm is the financial firm that runs these stock exchanges, the largest stock exchanges in the world. And of course, they have many, many financial analysts that put together these reports, again, using data. It's factual. None of this is opinion. This is just the reports they have put together based on the existing data of traders in the world. Again, this is linked in the description, and I highly recommend you go take a look at some of these because they are very interesting, okay? Now, we've been talking about the average investor, the average day trader, someone at home like me or you who's trying to trade. But these scorecards are tracking the hedge funds and the mutual funds of the world, professional active investors, not your average person at home on their computer day trading, but professional financial analysts, part of hedge funds, firms that are trying to consistently make a profit and, of course, beat the market. And what have they found? Of course, they have found the average hedge fund, the average actively managed fund does not outperform their benchmark. Now, what this means is, for example, if a hedge fund is trading in small cap stocks, they do not outperform the US small cap index. If a hedge fund is trading large cap funds, blue chip stocks, they do not outperform the index. Here is data they've put together tracking actively managed funds over 20 years from 2001 to 2021. We can see that for every sector, the average actively managed fund does not beat the benchmark. For large cap stocks, 94% of funds do not outperform the benchmark. For growth funds, it's 99%. This is not even just the average. This is the vast majority of them. If it was 50% of them beat the benchmark, that means it's about a coin flip. Some firms are better at it, some firms are worse at it. It's about the average, and you probably should just invest in the benchmark because it's a coin flip either way. Well, this is showing you that it's actually way worse than that. By choosing to invest in one of these actively managed funds instead of the benchmark, you've now significantly reduced your odds of beating the benchmark by a large margin. And again, this is not the average Joe day trader. These are professionally managed funds. People with their PhDs, financial analysts, and teams of people working together, trying to pick the best stocks, trying to trade. They will use any strategy you can think of. They've got algorithm trading. They have complex financial models that they put together to try and beat the markets. And the data shows they cannot do it. All right, here's another article. This again is using the S&P indices scorecards to show that around 95% of actively managed funds do not beat the market. And now you may be thinking, okay, well, if this is the case, why do hedge funds exist? Why do mutual funds exist? Well, mutual funds and hedge funds exist to make money, right? They charge a management fee, and oftentimes they charge a fee on top of any returns they get. Their goal is to convince people to invest in them and tell them that they can outperform the market and make them good returns. And a lot of hedge funds, their clients are very rich and smart people, and they're able to convince them that they're going to do it. Obviously, the hedge fund and mutual fund industry is huge, so those people are falling for it. Now, of course, when we look at TikTok and YouTube traders offering basically the same thing, it's, they're not telling you to invest in their fund, but they're telling you they'll teach you how to invest, or you can just copy their trades. Of course, it's entirely possible in this industry too, that despite the vast majority of them not being able to do what they promise, they can convince a lot of people to give them money. And now, this phenomenon of hedge funds not being able to outperform the market famously culminated in a bet between Warren Buffett and a hedge fund manager. So the famous $1 million bet was a bet that the market index would outperform a hand-picked basket of actively managed hedge funds. And of course, his opponent in this bet chose what he thought would be the most reputable, most likely to outperform the market, actively managed funds. And 10 years later, he lost that bet, proving Warren Buffett right that investors are much better off investing into the index rather than an actively managed fund. Now, there are some exceptions. Of course, it's not literally impossible to beat the market. Some do it. And obviously the argument is that the small minority of traders who are able to outperform do so because of luck and not because of their skill or talent. But there is one great example I found of a fund that was able to consistently outperform the market, and it is called the Medallion Fund. Now, the Medallion Fund is considered one of the most successful hedge funds ever, outperforming the market year after year. Now, on the Wikipedia article for Renaissance Technologies, the firm that owns this fund, it says that a third of its analysts have PhDs not in finance, but in fields like computer science, physics, mathematics, and statistics. It has been called the best physics and mathematics department in the world, and they avoid hiring anyone from Wall Street because they know that if there is a way to beat the market consistently, it is by using statistical models, data, and algorithmic trading to take advantage of arbitrage in the market, right? There is no emotion involved whatsoever. There is no secret edge you can learn in trading. It is all mathematical models. So they have this team of dozens and dozens of PhD mathematicians, statisticians, and they write algorithms to trade in the market. And of course, they don't offer these services to anyone else in the world, and all the profits of the funds go to the employees and the owners of the fund. If you really knew the way to consistently trade your way to outperforming the market, you wouldn't tell anyone, because then they would take advantage of that opportunity and it would no longer be as lucrative an opportunity. So there you go. The one example I could find of day traders who really knew what they were doing, who could use mathematical models to consistently outperform the market, are basically some of the smartest mathematicians and statisticians in the world working together writing algorithmic models. Not some 17-year-old in his basement with a Discord server, okay? The fact that any of these TikTok or YouTube traders are claiming that they can make you profits by teaching you their day trading method is a complete lie, right? And it becomes so obvious when you actually do the research on it. Much like how the Medallion Fund keeps all of their trading secrets a secret, if any of these traders really did know a method of consistently making profits from day trading, they wouldn't be sharing it because they would make enough money through trading. They wouldn't need to sell you their course. But here's the thing, all the money they've made to be able to show you their Rolex or their fancy car is from the courses they sell. It's such an easy illusion to keep going. They make more money from people paying for their course, which they can then use to show off how much money they have to keep the illusion going. They can cherry pick trades, promote them on social media to make it seem like they know what they're doing, but they don't. They're trying to trick you, and I found a number of cases against people like this who were charged with fraud. Here's a case from 2011 against a firm called Better Trades. They had to pay over $750,000, and what they did was they sold people the idea that they could teach them how to trade options for profit. And this is one of the most common things you see on the internet nowadays. It's people telling you that they know how to trade options. Now, a quick 5-minute stroll into Wall Street Bets on Reddit will show you the casino-like nature of options trading. And without going further in depth on that, just imagine all what we've talked about day trading, actively managed funds, traders not being able to beat the market. Options and leverage trading just takes that to the next extreme. Options can go to 0 or up 100% within a day. So if day trading over the long term trends towards negative returns, then options trading does so even faster. But it's very easy for these con artists to show you the one options trade they made that went up 400% and try to convince you that they can recreate that on a consistent basis. Here's another one from a business called Invest Tools in 2009, the owners of which portrayed themselves as expert traders who made their living trading securities and misled investors into believing that they too could make extraordinary profits by purchasing their expensive courses. While behind the scenes, they had hundreds of thousands of dollars in losses in their own personal accounts. So we know it's possible. And furthermore, I hope that we can accept after this video that this is the case for nearly all of them. I would say all of them, right? Now, the thing is, I'm sure some of these traders, especially the younger ones, maybe the 16, 17-year-olds on TikTok, they might have convinced themselves that they're able to consistently beat the market because they had a lucky streak for a few weeks and, maybe made 50% on some options they traded. But the thing is, for other people, some of the most infamous ones with hundreds of thousands of followers, they are basically con men. They are running a scam, similar to Jordan Belfort from The Wolf of Wall Street, where his firm preyed upon investors by offering them cheap penny stocks and taking the fees. These online day traders selling you their courses are trying to take your money by convincing you that they can offer you spectacular returns. And yes, it is illegal. Now, the sad reality is the majority of them won't face any repercussion. I'm sure the SEC doesn't have time to go after every 16-year-old offering their Discord trading course. But what we can do is not fall for them. And if you see them while you're scrolling TikTok or while you're on YouTube, call them out. Tell other people this is a scam. They're trying to take your money. Hedge funds can't beat the market, and there's no way that these guys can either. So there you go. Please, if you have any questions on this, leave them in the comments. And if I find any arguments or flaws in what I've presented here today, I will be sure to make a follow-up video because I want this to be as in-depth as it can be. Now, unfortunately, at the end of the day, of course, these traders could just say, no, trust me, I'm the 1%. I really know what's going on. And it's really hard to prove them wrong because, you'll have to, go in there and analyze exactly what they're doing, which of course we're not going to do because we're not going to pay for their course. But, I've made videos on TikTok, for example, for some of the ones who do make their trades publicly known. One of the biggest ones that blew up was the influencer trying to sell her course, who then picked cryptocurrencies, which performed horribly over the next year. But there it is. Day trading is not profitable for the vast majority of people. Trading in general does not outperform the stock market, even when performed by professionals who've been doing this for decades, hedge fund managers, financial analysts. And if you've learned this lesson, by simply investing into the market index, you are going to be able to outperform the vast majority of people, right? Once we've learned this lesson, now we can start to go into, okay, well, we know that buying and holding long-term assets is the way to go. There are many investors who have been able to outperform the market. For example, Michael Burry, Bill Miller, whose hedge fund famously outperformed the market, he is now 50% in Bitcoin. He bought and he's holding. Similarly, in the Broke Student Advice portfolio, where I've been showing every trade we do for free, because I wanted there to be a Discord server out there that's free and shows what an actual investing portfolio would look like, not calling out daily options trades, but simply showing how frequently I dollar cost average into my long-term investments like Bitcoin, Ethereum, and the market index. That has returned also very well. So I'm not making the claim it's not possible to beat the market, but I think we have fairly clearly shown that it's not impossible, but extremely unlikely that you will beat the market by day trading. And the more frequently you try to day trade and the longer you spend doing it, the higher the chances are that you are going to trend towards negative returns. All right. This has been a long one. Thank you if you sat through all of this. And hopefully, after watching this video, the next time you see someone telling you they know how to consistently outperform the market by day trading, you will know that they are either lying to you or they've deluded themselves. Thanks for watching.